Okay, miss. Okay, welcome. This is the seventh of our EDAISA Innovation Talks. And we are here. I hope that everybody is around here. So first, I just want to welcome you and thank you for your participation. I don't think that I can do at least justice about your backgrounds when I get to explain them. So can you please briefly explain your backgrounds and of course your venture capital's background, give a little bit more information about the venture capital, its investments and aspirations, so that we can roll the discussion over. Thank you for participation again.
Okay. Shall I start?
Please.
Go ahead. Okay. Thank you very much for the invitation, first of all. My name is Bashar Yendunya. I work as Vice President at 212. I'm mainly responsible for deal flow, investments, portfolio management, and I also have fundraising and business development activities as well. I hold positions as board member and observer of our portfolio companies. Before 212, I worked in private equity and investment banking, and I have an exit from one of the companies I co-started in my early careers. I'm an industrial engineer by training. I got my degree from Bilkent University, and I have an MBA from INSEAD. Maybe I can quickly introduce 212 as well. We are one of the first venture capital funds in Turkey, started in 2012 with a $30 million fund. We made 12 investments, 4 of them became very successful. We still have 3 of them in our portfolio. And then in 2018, we started our second fund, which is 50 million euros, and we invest up to 5 million euros to mostly enterprise software businesses operating with B2B business models. We can invest anywhere, but most of the investments are to Turkish entrepreneurs, either in Turkey or beyond Turkey. We try to invest in companies where we think we can add value. That's very important for us. We have a team of 14 people with diverse backgrounds. And I think starting from Q2 of this year, we will raise another fund, probably 70 to 90 million euros, which can make up to 7 to 9 million euros investment per company.
Okay. Thanks for the invite. My name is Fırat Özpınar. I am a materials engineer by education from Middle East Technical University in Ankara. Then I did my MBA in the US at Babson College, a small college just outside of Boston. Upon my return, I worked for the limited partners in the venture capital private equity ecosystem. So I worked at the Technology Development Foundation of Turkey, which is one of the first institutional LPs. And then I worked at the European Investment Fund, which is the largest fund of funds throughout Europe. I joined DCP, Diffusion Capital Partners, in 2015. And to give you just a little bit background of what DCP does, DCP is a venture capital fund investing in seed and Series A stages, predominantly in deep tech companies. What I mean by deep tech is sometimes it gets lost, like what constitutes deep tech. We are focusing on companies and startups that have some sort of like a defendable intellectual property. This might be in the form of patents or in the form of, let's say, some sort of like a research and development effort behind it. Our first fund was established in 2015. It was a 37 million euro fund. We invested in 18 companies. 14 of them are still active. We established our second fund in 2020, again around 40 million. And currently we have 10 portfolio companies in the second fund. When you look at the portfolio distribution in terms of sectors, half of it is in, let's say, IT space, but we don't really do e-commerce or marketplaces. We always look for some sort of like, as I said, science or technology edge behind the companies. So it's mostly cybersecurity or machine learning platforms and that sort of companies. 25% of it is in medical devices, and when I say medical devices, we are focusing on we believe that there's an inherent capacity in Turkey to develop medical devices. So 25% of it is in medical devices. We don't do drugs, and the 25% is mostly clean tech and agricultural tech. So that's a broad distribution of the portfolio. That's it in a nutshell.
Okay, let me just open up the discussion with a little bit philosophical base. What do you think about the role of VCs in the innovation and entrepreneurship ecosystem? I mean, what role do you see that VCs play? And I'm asking this because can you briefly describe your position in this? I mean, there are many actors in the ecosystem, and what do you think the VCs are? How should we position them? I'm asking this because many people probably listening to us do not have any conception about what a VC does, and maybe just rushing to you with just, we need money, why don't you give us money kind of, questions. Can you give us a brief description about what a VC does? Where is it is positioned in the, innovation ecosystem? Let's start with you, and then maybe we can roll the question over.
So maybe it's good to make a distinction between what constitutes innovation. So the way we look at it is there are like different kinds of innovation. So we try to separate the market into two. So there's the business market innovation, and then there is the, let's say, technological innovation. So as a deep tech fund, we try to focus more on the technological innovation side of things. We don't really want to get into business model innovation, where, a good example would be, I don't know, maybe low-cost carrier model of airlines, where the metrics are predetermined, everybody knows it, and then they try to replicate it in different markets. We don't think that's our value add, so we try to focus on the technological innovation aspect of the startups. So I think in that sense, venture capital plays a very important role, and sometimes we debate amongst ourselves as well, like are we still financing R&D, or are we actually financing market entry? It's not very easy to determine where R&D ends, where the innovation rollout to the market begins. But for the companies that we invest in, we actually...
Okay, maybe a little bit more voice is needed.
Is it better now?
Yeah.
Okay. So, I mean, there is this definition of technology readiness level,
yes.
which is a concept developed at NACE, I believe. But the way we look at it is like we want to invest in companies where we can actually have some sort of like a market signal 6 months from our investment. So in that sense, basically VCs, I think, play the role of, let's say, bridging that gap from the lab to the market by asking the difficult questions of like how that bridge will be crossed, and how the business model is structured. What are the plans? Like how is the team? Is the team, good for this journey, or well suited for this journey? So we try to answer those, let's say, hard questions before we invest. And I think it helps the entrepreneurs and the companies to actually become more prepared and maybe sometimes ask the hard questions to themselves as well, rather than just solely focusing on the technology aspects of things, taking a step back and then questioning what is the, let's say, bottom-up model that we need to build to make this technology reach the market. And when I say bottom-up, because I want to underline the bottom-up aspect of things, because like most of the business models or like ideas that we see are mostly top-down. So everybody can, most people can design their business plans about how big things are going to be, but we try to focus on since we are mostly focused on the very early seed stage, on the, let's say, first 5 customers, first 10 customers. Who are they going to be? Why are they going to buy your product? Why are they going to buy it from you? Do you have the right people to reach that sort of people? So in that sense, I think, it brings some sort of, let's say, a reality check to the ideas that technology-wise might be very good, but from a market perspective, maybe not so clear. So we try to bring that, let's say, perspective by asking the hard questions.
Okay, that's kind of a large question, I know. I mean, what I want to bring about is, what role do you think, and actually you have just, stepped in that part, technological innovation play in competitive advantage of a startup? I mean, is technological innovation is the only source of competitive advantage, and or how do we get to decide upon this? It's kind of a hard question. That's why I just want to bring it up and discuss among all people.
Yeah, maybe first, when I hear this question, I can start answering it by looking at the VC from the purpose of the VC's emergence. VC, I think in 1960s started. George Doerr, he's considered the godfather of VC. He started American Research and Development Corporation to fund the startups of the soldiers coming from World War II. And then he started funding, he started supporting them. And then once he made a huge success of investing $70,000 and making $160 million exit, then VC started to gain momentum. And then in time, we have seen that most of the big corporations, from Apple to IBM to others, they all started getting VC investments. And then we have also seen how VC invested companies started becoming successful. And when we say this, and when we look at the VC support, it can be seen as a financial support solely, but it's not just financial support. VCs mostly, we also heard that, but VCs mostly support in two ways. We can divide it into two. First, financial, of course, and second, strategic. Financial part is where VC inject money to the company, and the companies have the resources not to hire people, to test the product, to identify new markets, enter new markets, and to try new things. So this definitely helps the companies to build new technologies or to develop new technologies or to try new things. And strategic part, I think, which is more important, VCs often comes, most of the VCs, they have some domain expertise in these areas, and they provide strategic know-how, they provide strategic guidance. They can, and these guidance could be related with product strategy, market strategy, or any strategy-related item to any customer, potential customer, or potential investor introduction as well. So having a VC on board, generally, we have seen that resulted in positive outcomes for most of the companies, especially, of course, we are generalizing, but there are VCs and there are VCs, but it is the main idea.
So just to add on to that,
sure.
I think, when you make the distinction between business model innovation and technological innovation, I think VC serves the purpose of, let's say, an entrepreneur finds an opportunity which is working somewhere in the business innovation field. I think VC plays the role of disseminating that concept or that business model throughout the world, somewhat accelerating the let's say, diffusion of innovation. And on the technological side of things, because the technology is not yet proven yet, VCs can be instrumental in taking that, let's say, first risk for testing the market, and that once those risks are, let's say, mitigated, then it becomes more, let's say, proven for further investment. So I think in either case, it actually gets the innovation, enables the innovation faster to the market, and depending on the case by case, it can be really, really big, and the returns could be quite interesting.
Right now, I just want to delve a little bit more into the VC operation. I mean, for each and every one of us to understand the business model of a VC on your side, How does it operate? Can you just open it up? I mean, how do you get the money? How do you just spend the money? What are all these kinds of, roughly operational processes that VC does, so that we can unpack it a little bit more on the further question, especially coming to the deals with the startups and what you seek from the startups, etc., so that we can understand better the position of the venture capital and its operations.
Mm-hmm. So you can think VC venture capital. You can think a venture capital firm as a normal startup. We need to raise money to make investments, and these investments should be successful, and then we make money. How do we attract capital and how do we raise money? VCs typically, they go to institutional investors, they go to corporations or wealthy individuals to show that they have enough expertise and experience to make good investments and to return good amount of to make good amount of returns. Once you start showing it to potential limited partners, these investors are called, and once you start receiving money from them, or commitment from them, you can start looking at investments, and you can start making new investments. And then, of course, as we discussed, we help VCs, we help startups to become more successful. We help them to raise more money from other investors, and we help them to exit their businesses so we can make money and we can return some of the capital to our investors as well. And VC operate like this. This is the cycle of the VC. And then when you become successful,
I want to underline, I mean, what's the difference between a strategic investor and a VC investor? So you never demand startup to pay you the profit part, the dividends, right? I mean, do you ask them to distribute the dividends?
We are generally interested in the proceeds that will come from the exits.
Okay. So we need to think about this exit thing, okay, right? I mean, this is another question, but it's coming up.
Exactly.
So you raise money, and then you invest in startups. Usually, what about the stakes? What can you call about it? I mean, like 10%, 15%, 20%?
Yeah, it depends on the strategy. It depends on the investment thesis. It depends on the VC. It depends on many things. But for us, we seek to get at least 10% shareholding at a startup. Invest at least 1.5 million euros as a first ticket. But of course, it depends on the stage of the company and depends on the main thing. Depends on the strategy.
To give a clue about people, about the percentages that these investors are asking right now, that's why I'm just
the idea is to get minority shareholding, and most of the VCs they don't want to involve in day-to-day business. You should think that everyone is on the same ship, and we all want to grow the business. So we don't want to interfere with anything. We just want to company to become successful, to have a larger size and have a exit with a profitable exit that will satisfy all investors. So that's the main goal, that's the objective, and we all play this game.
So fund structuring is, I think, there's a lot of things within the entrepreneurship ecosystem that is actually very similar at the fund of funds level, at the fund level, at the entrepreneur level. So when you say fundraising, as a startup, we also, as a team, try to identify a market opportunity in the domain that we are operating. And we try to go to the investors, mostly institutional investors, and try to convince them that we are the right people to benefit from that opportunity for, let's say, within the framework of our investment strategy. So we try to explain why there is this opportunity within, let's say, just to generalize, like a deep tech in Turkey. And then we make a case about it. We show some pipeline companies. We try to explain our track record, what we have done so far, what we are willing to do, our returns so far, and then try to convince them to make a commitment to the fund. So the funds are actually never holding, let's say, cash. They are always a partnership. It's a contractual structure obligation which is based on commitments. So once the VC manager, let's say, or like the GP, the general partner is the main term, finds a good company to invest within its investment strategy, it makes a capital call and calls the capital from the institutional investors. There are different kind of institutional investors within the let's say that invest in the space. Mostly they are let's say pension funds, university endowments, development financial institutions, corporates, and sometimes high net worth individuals or family offices. So these are the broad, let's say, investors that are investing in the venture capital funds.
And once this happens, you spend the money, right? Which is the part generally people are trying to understand. So how do you seek or scout, opportunities? I mean, on the startup side. Is it, like you've been to different types of road shows, different types of demo days, you actively seek where people are coming to you? How does it actually operate? What do you do? Again, let's just start with that.
It works both ways. I mean, we do inbound and outbound. So there are like so many startups that are coming in. And when they look at the, let's say, when they're in deep tech space, there are not that many addresses that they can go. So somehow they find us. And we also go to every event, whether it be, let's say, roadshow or, let's say, accelerator program, business plan contest, contacts with the investment banks active in the field, universities. We are very active in universities, especially. So we always try to source good companies, good prospects, and then we make an assessment on that. So the sourcing is one part of it, and then once we have one or two, let's say, meetings, then the screening part starts. We try to identify whether that opportunity fits within our investment strategy and whether it could be interesting from an investment perspective. One thing, maybe touching back onto your innovation question, is like VC is a very, let's say, unique investment class, which is demanding very high returns very fast. So there are not that many, let's say, businesses that can achieve that. This, I think, it creates some sort of like, let's say, maybe misunderstanding about the industry and whether VC is the one and only way for exploitation of the technology or innovation. So I think VC is accustomed to a very small subset of businesses and startups which could grow very fast. But there are quite a lot of, let's say, when we say like SME-like businesses, which are actually doing very respectable things and adding value to the economy, but maybe not very very good VC investments because of their growth prospects.
And because you cannot exit them with profitable type of returns. That's the side, I guess, huh?
You may, but I mean, what you try to do with a VC fund is you always try to build a portfolio.
Okay.
So once you say, okay, I've done this first close, now I'm going to invest in the companies, you probably are going for, let's say, 15 plus companies of portfolios. So the idea is VC is basically an outlier business. So what you want to do is you want to have like winners, and you want to be backing those winners as they progress. So that creates some sort of like a decision making, which actually makes you overweight your winners. And when you're thinking about during that screening process, you always look at each company whether this could be a, let's say, fund returner or so big. So in that sense, there are like certain, and whether it could be very big within your investment horizon, which is, let's say, 5-6 years. So which is
that's the time horizon. I mean, the 5-6 years, or maybe more, maybe less. What can you say about this, Rashad?
The typical fund structure is fund life is 10 years. First 5 years investment, second 5 years divestment mostly. And you don't make new investments after the year 5. That's why 5 to 7 years.
You exclude follow-ups or include?
No, new investments.
New investments.
You can do follow-ons, and you can support the companies that are already existing in your portfolio. But if, let's say, our first fund, it is at year 12, we needed to extend the fund because there are very successful companies. One became unicorn, the other two are performing well. So we had to get advisory board approval to extend it. But typical fund life is 10 years, and you need to generate profit as fast as possible.
True. So we have a short time of horizon to manage these returns and everything. That's why it's kind of a aggressive type of
Exactly.
point. Okay. So by the way, I need to remind people on the online that they can just shoot out all the questions. We will take them, and probably Alper will help me about asking them. If you have any questions online, please just write them down on the chat screen so that we can ask here. Okay, so we make the investments, and what do you? How do you screen them? What are the basic type of qualities? When people, and there are people around here, I know, when they come to a VC, what kind of self-assessment perhaps they should make in order to be considered by a VC as a good opportunity?
So we always try to look at different aspects of the ideas that are coming in to our fund. So everybody will tell you that it's the market, it's the team, it's the technology. But I think the most important thing is the team, and probably most of the VCs will tell you the same thing.
Team. Okay, we need to underline that. Okay, team. Yeah. So what kind of team? What about the team? Yes.
So one of the fundamental risks that we see is if there is a, let's say, falling out among the team members along the way, it's one of the hardest problems to solve. And that probably is the number one company killer within any, let's say, disagreement, or let's say for any cause. If there's a fallout of founders, then it becomes a very difficult situation for us. So one of the things that we look at is whether the team members have previous working experience for a certain period, or are they just fresh out of college, just team coming together and then launching their own business for the first time. That's sort of, let's say, not very let's say concrete, but we try to understand whether the team has worked together previously and whether they have overcome obstacles together. So that gives us some sort of like an indication that, okay, this team has been through some rough times, so they can actually be together for a period of time. We always have some sort of like a clauses within our SHAs and investment documentation to maintain that this structure is preserved within allowable limits. But that's the one thing that we always look at. And then the second one is whether it is the skill-wise, are they well balanced? So most of the time what we see is very strong technical teams, but then they are lacking maybe the business development or marketing or sales experience. So we would like to see some sort of like a balanced team and some diversity within that team, so that they complement each other rather than. And then the third thing is whether the roles are well identified, whether people know who is going to do what. And do they have the, let's say, network or the contacts in the industry that they want to operate? So that's probably in a nutshell what we look at in a team.
What can you add? And I want to add a little bit question.
Maybe a few additions to the team. I mean, team is very important, of course. We definitely invest in teams, not the companies. And two more items that can be important. One, most of the VCs, they are hesitant to make investments to solo founders because we all look at team members that complement each other, first thing. Second is, sometimes we look at companies, they have a very good team, but their product is not there yet. Sometimes our bet is that the team has the ability to pilot the product, to pivot the product. They can launch a new product. They they already have an expertise, they already have some vision, their background is there, but existing product, probably it will not work. But then your bet will be on team's ability to launch new product. That's also important. And another item is, of course, team's ability to hire very good people and retain them. This is also very important. Sometimes you see good people, super genius, but they cannot hire people or they cannot retain people. In the
So
organization.
people management.
People management is very important.
What about the solo entrepreneurs? I mean, even though they have a team, but they are on salary, but they work together. Do you still, push them to become partners, or do you even do this, or just, just cross it out?
It is generally it is difficult case. There should be a very strong solo founder, like a Superman or Superwoman that can manage everything. Because when we look at our best success stories, Insider, 5 founders, one of the founder responsible for sales. He doesn't even have a house. He's moving. He's changing countries every 2 months. He's making sales. That kind of dedication you look for. And another one only focusing on technical. Another one focusing on customer support. Another one just CEO role. Then you you generally want people who are dedicated enough who are driven enough to create a success story. And without having co-founder level involvement, it's very difficult.
Okay, I just want to bring up the hardest question for everybody, I guess. What do you think about the academic persona as a startup founder? I mean, it may be a little bit prejudiced type of question, and I don't want to stigmatize anybody or classify anybody, overgeneralize anything. But what do you think about the academic persona? Because we are an alliance of 9, now becoming 10 universities, and there are eager researchers who are willing to create their startups or have even created their startups. So what can you say about this kind of persona?
So I think maybe touching upon the solo entrepreneur part, I think as long as the entrepreneur, whether he or she is a single entrepreneur or there's a team around them, they need to be good team builders. I think this is very true for academic entrepreneurs as well. So I think entrepreneurship in general is some kind of like a different breed, or entrepreneurs are a different breed, or like they have some sort of like a different mindset. But they understand the importance of, let's say, team building. And I think in that sense, since it's a numbers game, I can say that, okay, I can go to any, let's say, department in any university and say, okay, who is the, let's say, academician? I can ask people who's the academician with the most entrepreneurial skills. And people will probably tell me among the, let's say, 40, 50 academics there, they will probably tell me 2 or 3 people. So in that sense, I think, you always exhibit entrepreneurial skills within the academia as well. But I think, from our experience, what we see that, we consider ourselves lucky because like the investments that we make are mostly in the deep tech space, and we get to learn the basics and the nitty-gritty of everything from the best person who knows that, who has dedicated his life to that research. So in that sense, from a technical perspective, it is very, first exciting for us and fulfilling for us. But what we try to do when we put on our investor hats is whether this person is able to put together a team, inspire that team, and then make this a reality. So that we try to look for that sort of qualifications. So I think, rather than having academic entrepreneurs, I think is very good because like you're probably talking to one of the, let's say, 4 or 5 people in the country who knows that domain very well. But then you try to assess whether how can we complement this team with the right, let's say, business development, marketing people, and whether this person is something that can inspire people to work for him within different roles. So that's the kind of assessment that we try to look at. So we don't actually say, okay, academics are not good entrepreneurs. In general, most of the people I think do not have the, let's say, drive or I don't know, like the right mindset to become an entrepreneur. It's very challenging. It's very demanding. So it's a numbers game, whether you are in academia or in normal setting.
I think this is applicable for most of the VCs that are not deep tech. VCs mostly look at the commercialization of the product or idea, and when I look at the projects that are coming from academia, I see a deep technical knowledge, a very good technicality behind it. But most of the times, either the approach or the product is not scalable yet. So we discussed the fund structure. You need to make investments in the first 5 years, then make an exit in between 5 and 10th year. Then when you consider the fund structure, it is generally very difficult for you to back the academicians in the when you look at initially. But then when an academician solve it by surrounding themselves with good team members and by proving themselves and finding some good product market fit for their products, then they will definitely have a competitive advantage over the competitors, because they are the ones knowing the industry, probably the solutions very well than over the competition. So it is not just one answer. It depends case by case, and because this is the main pattern, we are discussing this.
What is important, I think, is like, or like a common pitfall is like falling in love with the technology. So like, technology in its sense is not going to, without identifying the real problem that it solves or the need in the industry. So if the entrepreneur has actually done the, let's say, work and then identified that, let's say, fit or need, then it's a much easier conversation.
Very interesting. So just we now talked about how you select or scout, and then what about the deal process? Can we just unpack it a little bit more? I mean, when does the application start? How does it unfold in consecutive stages, like the term sheet and the contract, and what happens afterwards? Can you just briefly explain a little bit more about the process, and of course the time horizon, which generally starts from this part, and how much time does it generally take to get the money to the account?
I think this is one of the most frequent questions that are asked.
Of course, I need to ask this.
But it also depends. Our fastest investment was 13 days.
Oh,
longest was 12 months.
You said days.
Days, yes.
Oh, let's hear it. Okay.
Longest 12 months. So it also depends. There are many things, of course, when there's human factor. But the usual process is like this. We first source deals, inbound or outbound. It comes from our network, or we identify a company. We have an investment team. We have the first meeting. It's generally 30 to 40 minutes meeting. We try to get to know the team, understand the product, the market, and a little bit more. And then we have a quick assessment within the investment team. Either we want to continue or not. If we want to continue, we dig deeper into the industry a little bit more. We try to identify first market opportunity within ourselves. Then if we think that there's a good market and the team looks okay, then we have second meeting with a little bit longer time, and then we ask more detailed questions. And after the meeting, if we still like the company, we send a question list, a long question list, to ask our questions that we, in different areas from HR to product to some potential risks to their future vision to exit. And then we have partner meetings, and then we give term sheet to them. In the term sheet is the document, it's a non-binding document where you can see all the conditions of the investments and partnership and the shareholding. We would like to make a, let's say, $1 million investment at $10 million valuation. We would like to get these kind of rights. We would like to be a board member of the company. We would like to be involved in these decision-making processes and these kind of things. And we also, of course, try to protect ourselves if these kind of cases occur. We need to be reimbursed or something like that. And then after this process, we start due diligence process where we look at the company legally, financially, maybe sometimes technically, and in other aspects. It also takes...
Do you do it yourself or outsource partners?
It also depends on the size of the company. Sometimes we outsource people, sometimes we have some in-house experts that we use. Then if we don't see any red flags, we want to continue investing, and now we have much detailed agreements. These are shareholders agreements, share purchase agreements, and could be different kind of agreements depending on the jurisdiction of the company. And it also takes time, and then we make an investment. We call capital from our investors, and we wire the money. And typically, it should take, I think, maybe 4 months, but it can take shorter or longer.
So it's kind of an average. I want to get, you know, a little bit number from your mouth. Why? Yeah. Because people are just right now waiting, okay? How much money do we have until that? And so they need to apply to you before their money runs out, right? This is the predominant type of thing.
Exactly. They need, I think they need to be in touch with all the investors from maybe after proving that they have some product market fit. They should be in constant touch with investors, updating them. They shouldn't come to us before 3 or 4 months of, you know, depleting the money.
Yeah. Can you say more about this?
So I think, you know, this is one of the things that is also similar in fundraising for funds and fundraising for entrepreneurs as well. It's always good to show momentum and, you know, determine some sort of like a touch points with your investors and, you know, communicating them the progress that you are making. I think in our case, the normal investment process takes anywhere around probably like maybe 2 months to 6 months. But what we do is we always have certain companies in our radar that we have been following for, let's say, maybe longer than 1 year, 2 years. So one of the companies that we invested, we know them probably in more than 3 years. Not that, you know, we invested at that time, but once the company hits certain milestones, then we are always, we are ready, and we are more convinced of the momentum that the entrepreneurial team is building. And the other thing is, I think, you know, it is good to have some sort of like a process of this, let's say 3 to 4 months, because like everything that you do throughout that process towards the final investment decision and, you know, signing of the documentation, that process teaches you quite a bit about the team, entrepreneurial team, and then the business. So I think the idea is, since you are making, let's say, a partnership for long term, let's say 5, 6, 7, maybe sometimes longer periods of time, then you try to get to know the people that you're going to work with, and you try to build this rapport and what kind of, let's say, communication that you can establish with that team. Are you understanding each other? Are they coachable? Are they not coachable? You know, that sort of, let's say, convictions that you can actually find at that process. So I think, you know, it's anywhere between 3-4 months is reasonable. but then it is always best to keep in touch with any investors that you touch base with. Even if they don't invest in this round, they might be willing to invest in the next round, and that's also good, you know, for establishing funds as well.
And what happens after the post-investment? I mean, there are added values that you can create for startups. I mean, aside from the money, and maybe with the money, because you know there may be multiple rounds. And are you active in raising the funds in the next round, or how much are you active in the finding other investors or getting in touch, documentation, whatever is required? What kind of roles does actually the VC play around here? You have just said that yes, we are helping in a strategy-wise, but you know, let's be a little bit more specific. What kind of, I mean, do you help people to hire people? Do you help, I don't know, people to find customers? What kind of operations VC do? Look, maybe.
I think you can, you know, it's always good to talk in trees, right? Like, so
Yes.
I think, you know, it's financial discipline, you know, somewhat institutionalization of the startup rather than becoming.
Can you open it up a little bit? What do you mean by that?
I will. And then on the recruitment side, so like in the human resources department. So I think these three are the, let's say, most common ones. And I think people, let's say, maybe it's not very much underlined, but it's somewhat overlooked, is I think the main, let's say, value add of the VCs on the governance of the portfolio companies is to avoid common pitfalls. Most of the time, the entrepreneurial team, it's their either first or maybe at most second startup. But when you look at VCs, they are in this unique position to see tens of startups, how they're evolving, how they are managed. So they get to have, they get to see the common mistakes that other startups make. And I think the most important thing is, you know, bringing that knowledge, tacit knowledge to the company, and helping the founding team avoid, let's say, common pitfalls. And then that's, I think, the one thing that helps the companies to avoid it. And then the second part is, like, I think the financial discipline is very good. So we always ask for, let's say, we bring in, let's say, budgeting requirements, and then we also, you know, establish a good accounting system where, you know, most of the time technical founders are not very strong at. But since we establish it, then it puts their mind at ease. So
do you agree with that also? I mean, I get to see a lot of entrepreneurs who doesn't know anything about finance at the beginning. So is it kind of a difficulty? And do you really help them to do this?
You need to, because we are also backed by institutional investors where we report. We are also being audited. So our portfolio companies needs to be financial reporting wise stable and good
that's okay. That's just, I just want you to spell it out, because everybody really needs to do this, and they really lack this kind of know-how, and especially about the deep tech, because you know there are lots of different qualities about they are being positioned in you know, technological development zones. There are different types of incentive programs, and even we're just trying to get them up with an accounting system is kind of scary, right? So this is...
So yeah, that's one thing we do, and then we try to bring in the, let's say, most of the time the startups are like very small establishments, so they don't really have the resources to recruit the, let's say, the best talent in that area.
Yeah.
But once they are backed by a, let's say, somewhat well-known VC, and then they can demonstrate that they have the resources to back them up further, it becomes easier for them to attract that talent. And so I think, you know, VC investments helps in that front. And then we also bring in some governance rights, mostly to, let's say, protect and align the investor and entrepreneur towards the same goal. And I think that brings some sort of like, let's say, more proper way of doing business to a startup.
Okay. Anything to add?
Yeah, I think similar things, but we categorize, by the way, maybe it is not right to generalize the VC support because each VCs, they have different kind of methodologies. What we do is we try to be as active as we can in fundraising, growth, and HR as well. HR is the most important aspect nowadays. Human capital, finding good people is everything, by the way. Helping them onboard good people, build option pool structure is also very important. It is also becoming more, I think, common in Turkey, and I think it's more common in European countries, more common even in the US. And fundraising, another important aspect, you need to first starting from finding investors for the next rounds, finding downstream capital, and then helping them with financial reporting and presentations, emails, all the data room. These are important things. And then, of course, growth is very important, introducing them to any potential customers, stakeholders, partners in your network, or these kind of things, or any mentors. Maybe you see there's a need for advisory board for the company. They wanna really enter a new region, and they need some support in cracking the market. So you say, why not we bring a person who solved the problem before to do it, or we because we have now 19 companies in our in 2 funds. Some of them are more successful. We bring all of them together. We enable them to share best practices and to share some common good experiences. So we try to help them. We try to facilitate. We want them to see us as also as a gym membership. I mean, some entrepreneurs, they are really reluctant to share information and come to you. But some of the entrepreneurs, every day they ask you a question, they ask some support, and you are there to help them. So it's
okay. Maybe we're coming or approaching the end of my questions at least.
Okay.
Then I will try to take questions first from offline, and then if there are any coming from online as well. What about you think about the context bound of investment? I mean, before COVID, there is this understanding that people are actually investing only from a certain radius from their locality, and this is even true with the advanced markets. I mean, the US guys only invest in US, and not just US, but in the Bay Area. If they are founded in the Bay Area, in Silicon Valley, they just invest in Silicon Valley and nothing, never around. So do you think that this is kind of changing in the VC world? And in your own VCs, do you consider different types of geographical locations other than Turkey, for example?
So, I mean, we predominantly invest in Turkey. We have some, let's say, a bracket of funds that we can invest in international markets, but we don't actively source deals outside of Turkey. I think from a investee company perspective, or like from a VC perspective as well, there are very strong network effects within the VC and startup ecosystem. So, there are certain funds that have invested determined set of rules or standards that they can easily co-invest with. I think that's one thing that has not gone away after COVID. I think that network effect is still there. It's always this in close proximity to each other, or that's how it evolved eventually at the start. From a investment perspective, during COVID, we did certain investments that we say that you can actually. One thing that has made it difficult for I think the portfolio companies is it has become much harder for different startups. But apart from that, I think the practice of, let's say, only investing in your, let's say, close proximity has
had a huge effect on this matter. We have seen the number of investments or amount of investments in Turkey. We can see this in our funds as well. Our first fund was mostly focused on Turkish investments. This fund, we have 50% to anywhere. That's why we look at everywhere. US,
So
MENA
do you
region,
just,
Europe.
have a boundary for investment? I mean, in terms of
We mostly
geography.
try to support Turkish founders in Turkey or abroad, Turkish diaspora. But we have some also non-Turkish founder companies as well. I mean, there are advantages and disadvantages of looking at investments. When you make an investment in your home country, in Turkey, we have also experienced this. Of course, you have a better network, you have a better access, you know other people, you help them find network, etc. This is good. But on the other side, you are also exposed to all the country risks or all the risks that potentially the company can face. We had this in our EasyCo sale. We were one of the largest shareholders, and before the exit, the acquiring company had a discount on the exit price, and because of the fluctuations of Turkish lira, and we have witnessed this. Therefore, in our second fund, we now encourage companies, even they are in Turkey, to sell beyond Turkey, and even if they do R&D in Turkey, to sell abroad. This is applicable for Turkish companies, and for the companies abroad, the market, especially if they're in developed markets, of course, the market is more open, but the couch is a little bit different. The legal part is a little bit different. The custom requirements and customer approach very different. So you need to get accustomed to some of these things, and it takes time. And it's not always very easy to understand and get to know and create value for these companies. So there are pluses and minuses, but at least you have a much larger pool of companies that you can look at.
My last question is, when should a startup come and search, knock on your door? And when is the good time that they really need to knock your door? I mean, you have certain things that you have just said, but I need a little bit precise answer. When you approach a VC rather than a, let's say, an angel investor, maybe in earlier rounds, when is the best time that they need to come and ask for you for your investment?
I mentioned this earlier, so that I mean, it's our job to always listen to entrepreneurs, right? So like at what stage it doesn't make much difference for us, even if it's not the right time for us to invest after we had the initial meeting. We always go back and look at them 6 months later, 1 year later, if they want to again reapproach and say, okay, let me tell you what happened since we last talked. But from a, let's say, VC perspective, I think the best time to approach a VC is once they have launched a new fund. So because like we are actually trying to build a portfolio, once you launch the fund, your risk profile is a blank sheet, right? Like you don't have anything. So once that portfolio starts to take shape, then you're always having some sort of, for example, you have some exposure to life sciences, and then maybe your appetite for life sciences might be going down. So that sort of portfolio construction should be always at the back of the founder's mind. So I think in that sense, the best time is once the fund is just launched. There are not that many portfolio companies, and if you think that the fund's investment strategy is close to what you guys are doing, then it might be the best time to
But you still seek product market fit and related type of measures, right? I mean, what kind of things perhaps you would really like to see?
I think ideally there would be, and because we do seed and Series A, we'd probably want to see traction with, let's say, several, let's say, beta customers.
Good.
Maybe like 2-3 customers, and then and see if they can give us the roadmap of how that could be scale to, let's say, 10 customers, how and why, then I think it might be a discussion that we would always like to have.
Okay.
When we look at our investments, I think 15 to 20% come from the ones in watch list. We also like tracking the companies, tracking the progress of the companies, and then invest later. Because when you first see them, you don't know them, and you need some time to digest everything and to understand what they do, and to track the progress and to understand really if they can do it or not. That's for sure. That's why we typically advise startups. This can be in time, but we advise them maybe after seeing some product market fit, they start sending investor maybe updates to many investors to let them know about the developments of the companies. I mean, these can be related with product, it can be related with the traction, your sales, or could be with new customer logos, or could be related with new HR or new markets you enter. This is very important. That's why I think you always need to be in touch with VCs after building the foundation of the company.
Do you particularly seek, for example, prior angel investment, or I mean, without any previous investment, I wouldn't even just care. Is it something, or you wouldn't?
We typically want to be the first institutional investor. There can be angel investors, but we don't require them to have any investors. But these investors can also teach the companies how to sell, how to build an organization, etc. It also
just come to my mind. What about the crowdfunding? What do you think about the crowdfunding?
I think crowdfunding has a very good purpose in demonstrating whether there is a desire for the product that you intend to build. So in that sense, it creates the validation that the VCs seek for. So if you can show that the crowdfunding, with a crowdfunding campaign, okay, I'm going to build this, and there is this much interest, people are willing to buy this. But at the same time, it's not very easy for, let's say, for us to assess. In addition to the initial demand, we need to understand why it's going to be a, let's say, not going to be a single product company, why it's going to be big. Can you build a business around this idea? So it has its upsides and downsides. So I think, crowdfunding is good for showing the validation, but you still have to make the case that this is just more than that campaign that you're running, and there could be a big business around that particular campaign.
What about the equity-based one? I mean, equity-based crowdfunding. Is it a good thing for equity-based crowdfunded type of company to be a partner as a VC, or back it up in the later stages, or it creates complication? What do you think about it?
It does. When you have so many, shareholders, then obviously it creates some operational burden.
I agree. I mean, company structure and company cap table shareholding structure is very important. If it makes any complications in the cap table, of course, it's very important, because you, as an investor, you typically want to invest in companies where the deal will be simple for us to execute. We don't want to generally deal with all the potential shareholder problems in the future. Of course, it depends on the shareholding agreement and other things, but it can make a difference. But having said that, sometimes we can see companies that cannot raise money from typical investors, angel investors, even friends and family, and they need to go crowdfunding. I also respect that. And with the crowdfunding, they can prove their product. Maybe they can even first have the first traction, and then they come to you. I mean, we try to look at objectively, as objective as we can, to these kind of companies as well.
Okay. Then I just want to turn around, right? I noticed that I never did that. Sorry. Any questions? Everything is so clear. You need to ask questions. You can never find these guys, huh? Question? Okay, we need the microphone so that everybody can hear. Generally, the first question brings everything around, huh?
A brilliant one. Thank you for today's session. Actually, it was really very useful. And while I was following you, just trying to understand about the ticket sizes, because sometimes, as far as I see, by being an entrepreneur and a startup, we are dealing with the right ticket sizes to understand.
A little bit more.
Yeah, maybe it's better. Yeah. So the question is how these ticket sizes are defined, and what should we know about the ticket size of the investment company, and how it is based, on the startup ecosystem.
So it's about ticket sizes, and how do you determine the ticket sizes?
Yeah.
Okay.
Just to clarify the question, is it how do we define the ticket sizes for the fund, or how as an entrepreneur you should approach the funds based?
The both are meaningful, actually. The both are meaningful.
For fund itself, when you are establishing the fund, when you are raising the fund, depending on the fund size and depending on the estimation of number of investments, you can identify your ticket size, and you need to make a fund model, and you can say, okay, we'll make at least 15 to 18 investments, and we have an investable capital of, let's say, $30 million. It could be $2 million on average per company, and then you come backwards to that. You say we will split it in 2 or 3 first ticket, follow-on investments, and then you come to the ticket sizes. Generally, it's the main approach. And then if you have higher conviction, of course, you can invest more than the average ticket size by having the advisory board approvals. But typically, you try to be in the range of this 2 million.
So switch the question on its head. So like when you look at it as an entrepreneur, like the venture capital is the most expensive, let's say, form of financing that an entrepreneur can get.
Yeah.
So the idea is to always have some sort of like a plan for, let's say, 12 to 24 months or 18 to 24 months. And then at the end of 24 months, that the company valuation will be much higher. So the initial prospects that are coming to us should be based around that 18 to 24 months of runway. How much you need for that 18 to 24 months of runway. And then whether it could be fulfilled by a single investor or a bunch of investors is another story. So like normally if it's a big deal, we are a seed fund, we do Series A as well. Our ticket size is from, let's say, 500K to 2.5. We can go a little bit higher with advisory board approval as well. But what we try to do, or like most VCs, what they try to do is they try to, let's say, make a first check and then monitor the momentum. And then as the company delivers on the promise it made, then invest more to that company. So in that sense, it is always good to think of like, okay, maybe as an entrepreneur, how you're going to structure the deal and say, okay, I want to have like 3 investors with 500K ticket or like 1 million ticket, and then you can actually make that decision. And then it is better to have VCs compete for that slice of the pie rather than adjusting your business plan towards the ticket size of the VC.
One more question.
Please.
Yeah. Is it possible to?
But we cannot really hear you.
I'm sorry.
Yes.
I'm not keen to use the microphone.
Nobody is.
Yeah, I'm not alone. Thank you. So I was just wondering also about the cap approach. I don't know if this is something that is applicable when we are dealing, with the kind of investors. For example, at the moment, it is not clear the company size or the kind of evaluation is not clear right now. But with some kind of estimation, we are just, going to the investor or venture capitalist and ask for a kind of amount of money in parallel of some percentage, which is not so much clear at the moment. So, but by step, from time to time, I don't know, maybe 6 months ago, the company's evaluation will be much more clear. So it will be possible that maybe venture capital has invested this amount for this percentage, but at the moment this company was much more bigger. So so what you invested at that moment 6 months ago now is going to be XX. I don't know if my question is clear. Yeah, I know. I mean,
is it about the timing of investment and the length of the round, and how does the valuation change between these?
Because at the moment it will be kind of percentage, but that percentage will be something different after 6 months.
Okay, maybe you can take the question over. I think that. Okay, maybe I can also. Bring about the question about the SAFE or different types of investment practices. How do you think about that? I mean, are there any kind of methods that can ease about this process, or is there anything very easy way out from this valuation gamble?
I mean, first, maybe what is the valuation? First, we should ask this question. And the valuation is generally the amount that you think the company is valued based on its future performance. So you are expecting the company to achieve those results 6 months later, or 1 year later, or 2 years later. Therefore, it's difficult to say that in six months later the company is doing that. Of course, depending on the performance and future estimations, this can also change. Valuation is always difficult for the companies, especially if you are very early stage. It's difficult to come up with a specific number, and it's difficult to negotiate with investors. For in the US especially, it started in the US. They solved this problem by issuing some agreements called SAFE, or convertible note agreements. There are not specific valuations, specific numbers, but there are two numbers. First is the cap, is the maximum amount of the number that the valuation will be treated, that the shares will be converted. And then there's the discount factor. If you are an early stage investor, if the company gets another investment as an equity, then you will have 20%, 30% discount on the next round's financing, the valuation of that round. So there can be several ways to mitigate this, and this is more applicable for early stage companies. But it is always the case, unfortunately. And the typical, by the way, typical dilution that you need to expect for each round, I think between maybe 15 to 20, 25%.
By the way, do you encounter SAFE type of agreements in Turkey? I mean, since you are around, I mean, maybe not early stage investors, but do you hear them being made around?
There are some kind of applications. I think it is not specifically stated in the Turkish trade.
That's why I'm asking. We lack knowledge about the
but lawyers can create different kind of mechanisms to mirror that SAFE mechanisms.
I think there's too much emphasis on the valuation discussion, especially at the very early stage. So I think SAFE is just another way of delaying the, let's say, decision making to the next round. If you're at the very early stages, most of the time that the company valuation would be driven by the cap table, like how much the entrepreneurs want to retain, how much they are willing to provide to their employees in the form of option pool, and how much they need for that 12-month to 18-month period to demonstrate the milestones that they said they are going to achieve. Coming back to your question, you can obviously negotiate the milestones and say, okay, I accept this valuation, I'm going to get 500K, but if I hit this milestone, then I want the valuation to be this much. you can obviously negotiate that sort of metrics into the SHA. One thing about that is, I've never seen, or like very seldom, the business plans take place as they are written. And once you open that discussion, the VC will say, okay, I'm fine. I mean, we are more than happy. If you can make that revenue target a reality, we are okay to get, let's say, to provide you a higher valuation and then to get less stake. But it's a very difficult, it's most of the time not really attainable. So that you open that discussion, which is it may not be the good discussion when you're starting a partnership, but you can do it. I mean, I just don't want to mislead you. So it is doable.
Thank you very much.
We also try to avoid these milestone-based investments, the performances, the thresholds, and other kind of things. Especially for early-stage companies, we want them to focus on building the business as a general, not just focus on sales figures or.
So the idea is you don't really know, like when you're dealing with a single VC, even if you negotiate a certain valuation, you don't really know that the traction that you have demonstrated is valued that much or not. So the best way to do it is actually go out and do a fundraising at that time and then see what the market is saying. Maybe the market will be giving you a higher valuation than you first anticipated. So rather than having it could work against both sides. So I think it's better to have let's say, runway, and then at the end of that runway, you probably start fundraising 8 months before the end of when you still have 8 months of runway, and then you can get a higher valuation or lower valuation, and then the VC will be happy with it.
Thank you.
Any more questions? No internet? Really? Okay, so just from the follow-up from what you have said, so the money is given, I mean, if the ticket size is like 500K, so you give the money 500K lump sum. I mean, there is no just, if you hit this milestone, I give you 250 and then another 250. I mean, what about the money transfer issue? That's because I want to make it clear for anybody listening to us.
I don't think it's the common practice or it's the general practice, but we don't want to do this generally. We invest the money thinking that the company, I mean, we want the company to think their long-term goals and 18 to 24 months ahead and raise the money accordingly. We don't want them to raise every 3 or 4 months, and we don't want to invest and we don't want them to have the money just for 3 months or 4 months and then seek out new money. So that's the thing. We want them to invest 500 or 1 million. That will be sufficient enough for them to maintain themselves and grow in at least some time. And then we can, of course, consider follow-on investments. Of course, the company, if the company is not in good situation and they need money, they can come to us and we can consider options, what options we can have together.
But again, like when you come back to the reason why we choose to invest in tranches, let's say, not maybe milestone based, but in seed, CSA, CSV, and it's just to provide more, let's say, motivation for the entrepreneur, because like maybe the entrepreneur can say, okay, 500 is not enough for me. I want to have at least 2.5 to make this happen. At the very early stage, then he or she will have to let go of a larger portion of the company because the valuation will not justify that. So I think it's better to have, let's say, whatever you need to make the, let's say, certain milestones for you to demonstrate that traction, and then maybe raise that larger round when the company is more valuable.
Otherwise, your 30 to 40% will go off in the very early stages. That's what you have.
So essentially, VCs are like momentum investors. So like we would like to invest in momentum. So like it's never you do one fundraising and it's over. It's very hard to do that. So like you always need to come back to the market and that also keeps the entrepreneur, let's say, on its toes, like what sort of metrics that they need to fulfill so that they can go back to the market if they need to.
Okay. Then I think any last words that you want to share with the entrepreneurial community? Then we will probably end our innovation talk.
We're very close by. Our office is at İTÜ Arı Teknokent, Arı 3, right next to Starbucks. So if you have any plans, any ideas that you want to talk, you're always welcome. And thank you for the invite.
Well, thank you.
Thank you very much. I will be also happy to hear from you if you have any ideas, or if you want to launch a company, or if you want to at least learn more about VC ecosystem or how to invest. Please, you have our emails.
Yeah, we will share them. I want to thank you on behalf of Istanbul Technical University, and of course on behalf of Eliza, especially the Innocore part, for taking part of this innovation talk. I hope that we can clarify at least about the VC's role in the innovation ecosystem. And again, thank you.
Thank you very much.
Thanks. We can go on, right? Teşekkür ederiz. Vallahi sağ olun.